Hi, everybody. This is Alan Ellman with our BCI podcast number 38. This one is titled Analyzing the Cost to Close When a Strike Moves Deep in the Money. And we're going to show a real-life example of a covered call trade with SolarEdge Technologies, Inc. that trades on the NASDAQ exchange under the ticker symbol SEDG. Now, when we sell a covered call, whether it's in the money or out of the money, and the price of the stock moves up exponentially, that leaves the strike deep, deep in the money. Now, the cost to close or buy back that option appears to be very expensive and presents us with a situation that we probably feel we shouldn't move forward with. In today's podcast, we're going to discuss SEDG when such a thing happened with a trade executed by one of our members. We're going to break it down, and we're going to show you that sometimes the cost to close isn't quite as unbearable as it might seem. Okay, so we're going to start off now by looking at some trade data prior to the cost to close calculations. Initially, SEDG was purchased at 94.27, and then the in-the-money 90 strike was sold at 6.30. And this is for a 1-month contract. Now, we know we can't count that entire 6.30 as profit because the $90 strike is $4.27 in the money, which means we're going to lose $4.27 on the sale of the stock. So that must be deducted from the 6.30. And the Ellman calculator will do that for us in order to get our time value initial profit. Now the stock price moved up dramatically to 104.85. And the cost to buy back that 90 call was $14.90. Well, that seems like way too expensive. Why would we ever do that? But in this case, we might. So let's first break down the way the trade was structured initially regarding our time value profit and protection to the downside. Now, in the multiple tab of the Ellman calculator, many of you are familiar with that, you'd fill in the blue cells on the left side of the spreadsheet with the data that we just discussed. Then the white cells on the right side of the spreadsheet become populated. So the 1-month breakdown is as follows. The time value return for 1 month is 2.3%, and that's deducting the 427 from the 630. So the calculator will do that for us. So a 1-month time value return of 2.3%. Now there's no upside potential because we're agreeing to sell the shares for a lower price than they're currently trading. We have a contract obligation to sell at 90 when the shares are trading at 94.27. So those shares can go to the moon. We're still only getting $90. That's the most that our shares can be worth as long as we have that contract obligation. But the intrinsic value component does afford us some downside protection. In this case, the calculator will reflect the 4.5% downside protection of that 2.3% time value profit. So what that means is the following. We are guaranteed a 2.3% 1-month return as long as share value does not decline by more than 4.5% by expiration. Or stated differently, as long as shares do not drop from 94.27 to below the 90 strike price. So a pretty good 1-month return with some solid protection, but we didn't need it because in this case we know that the price of the stock moved up exponentially. So the question becomes, how much is it going to cost us to unwind? Well, some people might say, you just told us, $14.90. Well, that's not exactly the case. So we turn to the Unwind Now tab of the elite version of the Ellman calculator. How much will it cost us in time value to close this trade? And once again, the information is put into the blue cells on the left side of the spreadsheet. Just to review, it's a 1-month contract where the shares were purchased at 94.27. The 90 strike was sold for 6.30. But today, the price of the stock moved up to 104.85, and the cost to close the 90 strike would be $14.90. So now, once that those blue cells are populated, the white cells on the right side of the spreadsheet are filled in, and we look to the bottom right of that spreadsheet, and it tells us the following. The actual time value cost to close is only 5 cents a share or $5 a contract. That represents a time value debit of 0.06%, just a tiny fraction of 1%. And the reason for that is the following. Even though it costs us $14.90 to close, of that $14.90, $14.85 is intrinsic value. That's money that we get back on share appreciation. So as long as that option obligation is in place, our shares can only be worth $90. But once we buy back that option for $14.90, our shares are now worth $104.85, an additional $14.85. So we have a debit of $14.90 on the option side, but a credit of $14.85 on the stock side, leaving us a net debit of 5 cents per share. So what does that mean? Let's say we do buy it back. What do we do next? Well, here's how we evaluate it. We say to ourselves, can we generate at least 1% more than the time value cost to close, depending on where we are in the contract? If we're midway through the contract or earlier, it definitely does. For in the last week of the contract, maybe not. In this case, we're looking to generate 1.06% or more in order to justify closing the entire position. So if we do so, we would then enter a new covered call trade with a different stock and generate that 1.06% or higher return. 1% a month is annualizes out to another 12% a year. Why not? And perhaps it could even be more than that. Now, the reason we use a different stock is because this one has gone up so much, so fast, we don't want to take a chance of profit taking. So we move on to a different security. Now, if we cannot generate more than 1.06% in the remaining time of that contract, then we just leave things alone, we take no action, and we reevaluate as expiration approaches. And if the strike is still in the money, we say to ourselves, does it make sense to roll that option to the next contract month? And for that, we use the What Now tab of the Element calculator. And of course, rolling options is something that we've covered in all of our books and DVDs. We will be doing podcasts on those. We have webinars and so on and so forth. So it's beyond the scope of this particular podcast, but if we decide not to unwind mid-contract and the strike is still in the money, then we do consider rolling the option based on our strategy criteria. So let's just take an overview of this podcast. Entering a covered call trade encompasses the first two required skills, which is stock selection and option selection. Then once we do that, then the third required skill, position management, kicks in. And that will allow us both to mitigate losses and enhance potential gains, as it would if the strike moves deep in the money and we unwind that position. We can then generate an additional second income stream with the same cash investment. Now, once we do that, no matter when we enter a covered call trade, we always include our buy to close limit orders after entering the covered call trade, because that will partially automate the position. Now, in this case, when we generated $6.30 initially, a buy to close limit order at 20% of that amount, or $1.25, would immediately be entered. And if that threshold is hit, the price of the stock goes down, which it didn't in this case, but if it did, then that would automatically execute, and then we can make a decision as to whether or not we're going to roll down, wait to sell the same option, sell the stock. We have various choices to make once that short call is sold, if in fact that threshold is ever met during that contract. So just want to remind everybody that the Element calculator, at least the basic version, is located on all of our web pages. Just click on the free resources link at the top black bar of our web pages, and you can download the Element calculator. We have a put calculator and many other free resources there as well. And in the blue collar store, we have a whole series of hard and soft cover books, ebooks, online video programs, calculators, spreadsheets, trade planners, mentoring services, and so on and so forth that will allow us to master option selling strategies. I want to thank everybody for taking the time to listen to and or watch this podcast, BCI podcast number 38, Analyzing the Cost to Close When a Strike Moves Deep in the Money, a real-life example with SolarEdge Technologies. Ladies and gentlemen, I hope you enjoyed this podcast, and most importantly, I hope you benefit from it. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.